Hello everyone, my name is Nathan Corroy from Richardson Financial Group, joined by Dan Brown, our Director of Investment Management, and we are here today with the third quarter 2023 Economic and Investment Update. Dan, after a solid start to the year with strong positive returns through the first half and into the month of July, we saw a bit of a pullback starting in August and certainly continuing in this most recent month of September. Do you want to maybe talk a little bit about some of the specifics on those negative returns, and then we can dig into some of the catalysts behind that?
Sure, Nathan. So as you mentioned, first negative quarter in a while, actually for the first negative quarter since third quarter of last year, 2022. So we had a pretty decent run of financial market performance up into the most recent quarter. And a lot of the negative returns were in the 2 months of August and September. And some of the negative catalysts that we saw that influenced the financial markets were higher oil prices. So oil rose to about $95 a barrel in September. Higher mortgage rates and fear of a government shutdown that cropped up late in the quarter. But by far and away the biggest negative influence for the financial markets was the higher interest rate environment, which is sort of directly tied to the Federal Reserve.
And it seemed, Dan, like that negative performance was fairly broad-based. I think we had 9 of 11 economic sectors negative for the quarter. We saw negative returns in both fixed income and equities. Kind of seems like that negative market performance was fairly broad, would you say?
Yeah, what's also interesting about that is the fact that in many cases, fixed income, so bonds, actually performed as bad, or in some cases, a little bit worse than equities for the quarter.
And on that note, Dan, it seems safe to say that in the minds of investors and certainly in the financial press, the interest rate environment's kind of been the hot topic. What do we see in this past quarter in terms of any actions taken by the Fed and maybe the outlook going forward from here?
Yeah, so as far as actions on interest rates specifically, Fed did raise rates once in the quarter, only 0.25%. And that was early in the quarter, but we saw most of the interest rate move higher during the months of August and September. And we think that's primarily attributed to what we heard from the Federal Reserve, both in August and September. So in August, we heard the Fed speak at their annual Jackson Hole Symposium in Wyoming. And then in September, they kind of reiterated that at their regularly scheduled Fed meeting where they didn't raise interest rates, but they released some economic projections looking out into 2024. And what investors took away from that release is the fact that the Fed thinks interest rates are going to remain higher for longer. So investors sort of have to reassess their interest rate outlook because we've been noticing that for a while now, a lot of investors were expecting interest rate cuts to begin maybe first or second quarter of 2024. As inflation continues to cool, maybe the Fed can decrease their interest rates. But we don't think that's the case, and we've been thinking that for a while. So I think most of the investor community was a little bit off guard with their thinking, and that's what caused the negative interest rates. And again, we think higher for longer for interest rates until the Fed is very comfortable that inflation is on the downward trajectory and anchored at fairly low rates.
And Dan, with all that in mind, it seems pretty safe to say that our outlook going forward remains relatively cautious in the way that we're positioning client portfolios and kind of viewing this last quarter of the year here. Are you anticipating any significant changes on the horizon, either in the way we're positioned or the way we're seeing the markets going forward?
Yeah, I don't think we're anticipating any changes, Nathan, and a lot of that just goes back to the risks that we talked about. Mm-hmm. So still maintaining that fairly defensive positioning in equities than we traditionally have, so a cautious view. And a lot of it is the fact that we think the higher interest rate environment is going to extend into 2024.
Right.
And some of the other headwinds or risks that we're paying attention to, things like higher mortgage rates, higher oil prices, the fact that the consumer is sort of running down their savings level that they built up during the COVID periods. So we're still very comfortable holding a dedicated money market position in all of our discretionary managed portfolios. And that money market fund is now yielding, about 5.25%, right, with almost zero risk. So we're pretty content with that.
Well, with that, we want to thank everyone for watching. As always, we appreciate your continued trust. Hope you find these videos to be helpful, and by all means, feel free to share them with others if you think they'll find value as well.